Have you ever heard that making more money can actually mean you end up poorer because of taxes? Well, today we're going to completely demystify tax brackets. By the end of this, I promise, you'll get why that's not true and feel a whole lot better about your paycheck.
So let's just dive right in with the big one, the question that really seems to confuse everyone. If you get a pay raise and it bumps you into a higher tax bracket, could you actually end up with less cash in your pocket at the end of the day?
You know, that fear is so widespread, it's basically a financial urban legend. So in this first part, we are going to bust that myth wide open. I mean, have you ever heard someone say this, or hey, maybe you've even thought it yourself? It's a totally understandable fear if you're not sure how the system works. It kind of feels like you're getting penalized for getting ahead, right? Well, let me give you some fantastic news. That is absolutely 100% not how taxes in the US work. A pay raise will never, ever lead to less take-home pay, and I'm about to show you exactly why. All right, so to really get why a raise is always a win, I want you to just forget about all the complicated tax forms for a minute. Instead, we're going to use a super simple analogy. Let's talk about buckets. This is the key to everything. Okay, picture this. All the money you make in a year, that's like water. And the tax system, it's just a set of buckets, each one with a different tax rate. Your income, that water, starts pouring into the very first bucket, the one with the lowest rate. So here's how it works. Your first dollars earned fill up that 10% bucket. But what happens when it's full? Well, any more money you earn just overflows into the next bucket in line, the 12% one. And once that one's full, it spills into the 22% bucket, and it just keeps going like that. It's a one-way street. Now this is the most important part of this whole thing. That higher tax rate, it only hits the money that actually lands in that higher bucket. The money in all the lower buckets, it's safe. It stays right where it is, taxed at its original lower rate. Your entire income is never, ever taxed at your highest rate.
Okay, so this whole bucket system is the perfect way to understand two really important terms that people mix up all the time: your marginal tax rate and your effective tax rate.
And honestly, it's pretty simple when you think about it. The marginal rate, that's just the rate on your highest bucket, the rate you'd pay on the very next dollar you earn. But the effective rate, that's the actual blended average tax you pay on all your money combined. Let's break that down.
So, using our bucket analogy again, your marginal tax rate is just the percentage on the highest bucket your income has reached. It's the tax rate that applies only to those last few dollars that spilled over.
Your effective rate, though, that's the real story. Think of it like this. If you took all the tax you owe from all the different buckets, mixed it all together, and figured out the average rate on your total income, that's it. And here's the kicker. It will always be lower than your marginal rate.
All right, theory is great, but let's make this real. Let's put these buckets to work with an actual income and see how the math shakes out.
So let's say you're a single filer and you made $50,000 this year. How does the bucket system actually tax that money? Check this out. The first $11,000 of your income fills that first bucket. It gets taxed at 10%. So that's $1,100 in tax. Simple enough. But you made more than that, right? So the rest of your money, the next $39,000, spills over into the 12% bucket. That portion is taxed at 12%, which comes out to $4,680. You add those two tax amounts together, and your total tax bill is $5,780.
So, what does that $5,780 in tax actually mean? When you look at it as a percentage of your total $50,000 income, you get your effective tax rate, which is 11.56%.
And there you have it. That's the aha moment. Your marginal rate, the rate on your highest dollars, was 12%, but your effective rate, the rate you actually paid on every single dollar you earned, was only 11.5%. See the difference? You are not paying 12% on everything.
So, what does this all mean for you in the real world? It means you can go after that promotion, take that new job, and level up your paycheck without any of these irrational fears holding you back.
You know, this isn't really just about taxes. It's about feeling empowered. When you get the rules of the game, you can start playing it to win. And this kind of knowledge is just fundamental if you want to build wealth and make smart moves in your career.
So let's just quickly recap the big wins here. First, a pay raise always means more money in your pocket, period. And that's because your highest tax rate only applies to your highest dollars. The number you should really care about is your effective tax rate. That's your true average. So the bottom line is, never, ever be afraid to earn more money.
So there we have it. The fear of tax brackets is officially busted. Now that you have this clarity, you're in a way better position to make financial decisions. So the only real question left is, what's your next move going to be?